What's going on? Alex here, and today I'd like to welcome you to yet another Efros Financial Power Hour. Now, we had a guest ready to go for you. This was a mortgage expert who was supposed to be on the stream this evening, but this person had other things going on, so we're going to rock and roll with just you guys and myself today. But don't worry, we have plenty of awesome content for you. On that note, if you know any mortgage experts that are knowledgeable in the areas of lending for personal and commercial purposes, drop me a line, info@efrosfinancial.com, and I would love to have him on a future episode. And that's all I'll say about that. And what are we going to do? We're going to cancel the stream because our guest didn't show up? No, we're not going to do that. We don't quit. As they say in Hollywood, the show must go on. And it will. Even the famous Conan O'Brien infamously had a show where his guest didn't show up, and he persevered, and that's what we're going to do. When you have a small business, you have to know how to make it over the bumps. Every day, you're going to have new challenges, and you're going to have to figure out a way to make it work. That's what we're doing. So we're going to start with a bit of a detour, and then we're going to dive into some Reddit tax questions. Don't worry. We know we like our tax questions. But with the extended filing deadline for the personal tax returns just having passed, I wanted to address a bit of a change in vibe between tax professionals and their clients that has occurred over the last few years. Now, I know there's a bunch of tax professionals watching. I know some of you guys are attorneys, and you may have experienced this as well because there's more animosity and there's more friction lately. Why is that the case? And how do we get around it? How do we manage it and make this all work like a beautiful, fine-tuned machine? Part of the issue has to do with the fact that there were a number of tax changes that came into play over the last few years, many of them significant. Tax Cuts and Jobs Act in 2018 brought along the QBI deduction, massive changes in who gets the deduction, how to calculate it. Qualified opportunity zones came into play. The $10,000 SALT limitation became an issue. Then we had good old COVID come along with PPP loans, EIDL grants, targeted EIDL advances, the California Relief Grant. You had the California Golden State Stimulus Payment, economic impact payments, and it continues. For each one of these issues, we as tax professionals had to wrap our minds around it, research it, understand it, communicate it with our clients, and make sure that they were aware of how these changes impact their situations. And in some cases, if you take a client before all of these tax changes came into play and after, their tax situation is completely different. On top of that, you had schedules K2 and K3. At the beginning of this busy season, the IRS got in their head that they needed to add 20 extra pages to every pass-through return. So your S-Corps and the partnerships, 20 additional pages. I went through the K2 on one of my prior streams, and I mentioned it on the video called 5 Reasons Not to Become a Tax Preparer, because it was indeed ridiculous. And at the last minute, the IRS, in their infinite wisdom, did reverse course and say, look, you don't have to go super crazy with these schedules for this year, but next year they'll still be an issue. What's the point? The point is that we're navigating very turbulent waters, more so lately than was the case the past 10 years or the past 20 years. The number of tax changes and their significance has increased dramatically, and that's being felt on both sides. Well, how? Let's take a look. An example of this sentiment on the client side can be visualized here, but I guarantee you it's represented in many other forms. As you can see, this person on Reddit says, "Accountants, why is this the single hardest part of having a small business?" And this person was so angry that they deleted their post. Luckily, being an internet sleuth, I was able to track this post down on the Wayback Machine, okay? So, says here that this person has been through several accountants in 2.5 years. Here's the short version and still 8 paragraphs, but they are completely unreachable. Multiple calls, emails, and voicemails throughout the year go unreturned. Then they advise a tax strategy for us and disappear into the oak paneling, never to be heard from again. They lie about bookkeeping services. Then they tried a large firm because we thought the problem was that they were hiring little indie accountants who didn't know how to handle anything that wasn't a gas station or a lawn business. All right. The big firm bounced them around to a bunch of internal people. They got some billable hours out of it, but not much else. Then there were 2 other accountants. As you can see here, the story goes on, and it doesn't get any better. What have we been through? 6, 7 accountants now? Please help me. I've chewed through 2 bite guards. It's getting very Project Mayhem in the office. All right. As you can see, there's frustration on the client side. It's very apparent. I felt it in my practice as well. And we're going to go through some notes that I have and some things that I learned going through this busy season. It was an eventful one. But as we can see here, there's certainly frustration on the client side. On the other hand, we have a post here from the tax professional side, which gives us a bit of a view of the frustration that the tax pros are feeling, just to provide some counterpoint to the client side. This tax professional says, only had to dial the priority service 68 times to get through today. And it says, thanks NQ, more on what NQ is in a second, for robo-dialing the practitioner service line, taking up all the spots and selling them to us. Also, thanks Congress for continuing to let these companies profit on your decision to underfund the IRS. So what we're seeing is that the IRS is so backed up that before, the challenge was to get on hold, right? So basically, you would call the IRS and you would stay on hold for an extended period of time. That was the issue, in that it was an hour wait time, 2-hour wait time, 3-hour wait time. That was the chief complaint, but you would get through. That's the important point. So if your client had a tax issue, you knew that after some time on the phone, it would be resolved, hopefully before the end of the day. And that allowed for us to resolve straightforward tax issues for our clients as part of the service offering. So if we prepare a tax return and a little notice comes in, we can clarify it with the IRS without having to go too crazy and devote weeks and weeks and weeks of effort to try to get through. What's happened lately, especially since COVID happened, is that the challenge is no longer that you're going to have to hold for a long time. The problem is even getting the privilege of getting on hold, because what will happen very often is that you'll call the IRS, you'll go through their menu prompts, which takes a few minutes by itself, and then right before you get transferred to somebody, you get a message saying, we are experiencing heavy call volume and we cannot take your call at this time. Done. You're hung up on. There's no hold. There's no option to be called back many times. Some cases it does pop up, but very rarely. So what happens is you have to keep calling and calling and calling multiple times, each call several minutes because you have to get past the menu, to get the opportunity to then, after maybe 20, 30, 40, 50 calls, 68 calls in this case, to get through to then stay on hold for 2 to 3 hours to then talk to an IRS representative. And what can happen is that even after you make it through all that, the person that gets on the phone isn't able to help you. They'll tell you straight up, I haven't been trained in this topic. I can't help. And all of that effort goes right out the window because you have to start the process all over again. They will not transfer you to another knowledgeable representative. They won't get a supervisor on the phone. That's not how the IRS works. So to address this underfunding issue, which essentially that's what's stemming from this, we essentially have a service called NQ that makes it their business to have robo-dialers call the IRS, taking up spots on the queue and selling those spots to tax professionals who need to resolve issues for their clients. Now, on one hand, you might look at this and say, well, they're providing a very valuable service to the people who need it. That's one perspective. The other perspective is that they're providing that service at the cost of everyone else who's trying to get a hold of the IRS to clean up issues for their clients. So even though NQ can potentially help some people, they might also be hurting a lot more people that don't pay the premium to go through their service and choose to just call the IRS like we used to back in the good old days. All right? That's why there's frustration on the tax professional side. I just had a debate with a client recently whereby for a tax representation engagement where they got a notice from the IRS, it used to take 3 hours to resolve that issue. Now that same engagement can take 15 hours to address. So instead of billing for that service as an all-in fee, we have to bill for that service on a retainer basis like an attorney might charge. So we'll fill up the bucket of the retainer, use it up, and then as soon as it gets depleted, we have to refill that bucket, which clients have an issue with because they're not used to that model of billing. They're used to everything all encompassed. But again, we can't subsidize as professionals the ineffectiveness of the IRS by donating our time between the 3 hours that it used to take and the 15 hours that it could take now to resolve a tax issue. So hopefully that provides a little bit of insight on what the tax professionals are dealing with, because there are two sides to this coin and both sides can do a little bit better in terms of making this a smooth process. Now, I don't just look outward for issues like this and then reflect on them. I also look inward. This tax season was especially brutal because of all of the changes that came along and the fact that we want to make sure we check and double check our work and not rush it out the door. Because again, resolving issues, if a tax notice comes in, takes this long, whereas it used to take this long. So we want to make sure we get it right. And in doing so, it caused delays and it caused some clients to get upset, even though we try to set expectations from the get-go of what it entails, how long it could take, and all that. But again, we could always do better, and we're always learning. So I thought it would be useful, given that we just made it past the deadline, we're out of busy season technically, to look back and think, what could I have done better? What can my business have done to better facilitate the process, and what can we do better moving forward? Because there's certainly room for improvement, and I'm constantly learning. If you're a small business owner, you know what I'm talking about. And I took some notes on what can potentially be done better. And we're going to come back to this in a second because I wanted to first illustrate what the tax prep process for Efros Financial entails, just to give you a lay of the land so this makes all the sense for you. We start off the process with a beautiful email that goes out in January of each year to kick off the tax preparation process. And it looks like this. This is the exact email. And it has some steps outlined in it. One is to sign the engagement letter. All right. And if you tax pros out there who are watching don't get engagement letters signed, you're doing yourselves a tremendous disservice. Our engagement letter is 12 pages long, last time I checked. And you might say, 12 pages? That's crazy, Alex. Why do you have such a long engagement letter? Well, it started out as a 6-page letter, but then we encountered an issue with a client, and we knew that we definitely don't want to have this issue moving forward, so let's put that in the engagement letter. Then we had another issue with a client where there was a misunderstanding, and it could have been potentially communicated better, so let's put that into the engagement letter to make sure that there's no ambiguity moving forward. And pretty soon, you had provisions in the engagement letter that I can read it and think back to the particular client that triggered it. So we'll have the Charles provision, we'll have the Nancy provision. I'm just making up names. But the point is, if you're a tax pro and you get into this process, you don't have a solid engagement letter in place, you're doing yourself a disservice. If you look at the tax professionals subreddit, you'll see that so many of the problems begin with the following words. I didn't get an engagement letter signed, but. Well, then it's too late. But let's take a look at why there's a 9-page engagement letter, because that's kind of big. I actually looked at it. I thought it was 12. It's 9 pages. It might become 12 pages next season, but let's take a look. The first thing that we do is we outline exactly what we're looking to do for the client. Anybody with a small business, if you're not defining the scope of your work, I don't care if you're a graphic designer, exterminator, architect, what have you, if you're not defining exactly what you're going to do for the client, and more importantly, what you're not going to do, then you're just begging for what we call scope creep. You expect to deliver this much to the client, your client is expecting this much, and you're going to have to meet somewhere in the middle unless you're extremely specific with what you are and are not going to do. So in this case, we prepare and file the original, not amended, U.S. and federal state income tax returns as detailed below. Each federal return includes the preparation and filing of one state income tax return, if applicable. You see what we're doing there? Some individuals have 7 state income tax returns that they need filed. So this alleviates any ambiguity in how many are included versus how many result in an extra fee. And right here, it says additional state returns will be billed at the rate of $150 per state per tax year as applicable. All right? So we outlined personal income tax returns. These are not business returns. They don't include 14 LLCs unless we list them here beforehand. 2021 Form 1040, the estimated fee range is also included just to give an idea of what the lower and the upper range might be. We specify that if you started a new trade or business throughout the year, which everyone did during COVID, all right? Millions of people decided that they were internet content creators, let's call it. And all of a sudden they have a business activity that now we have to account for on the tax return. Usually there's no accounting or bookkeeping that goes along with that. And it's a first-time business owner that requires a little bit more hand-holding. So we make sure that there are fees for that. We had clients that decided to put their 4 extra homes up for rent on Airbnb. We also need to specify that since we need to calculate depreciation for all of those homes, that we need to bill extra for that as well. All right? And certainly everybody had a home office during COVID, right? Again, we need to incorporate that into the fee. It's extra work, it's extra time. Now, going through the engagement letter, we're not going to get into too many specifics here, but it specifies the deadlines in terms of when documentation must be received. It also specifies that client agrees that all income tax returns are subject to extension to allow additional time for preparation and review. I thought that's clear as day, but being that it's on the second page of the engagement letter, or the third page in this case, meant that some people didn't bother reading it, which led to the misunderstanding that all returns are going to be filed by April 15th, which is an unrealistic expectation because CPAs are employed throughout the year by doing the extended returns after April 15th to October 15th. That's just how the tax season and the rest of the year work. And we try to get as many returns done as possible by the deadline, but at some point, we have to hit the brakes and say, all right, from this day forward, we're just filing extensions because there's just, quite simply, is not enough time to file all the returns by the deadline. Now, if you're a big box place like H&R Block, for example, and you could churn through thousands of returns that are very straightforward and simple, more power to you. But most CPA firms don't deal with those super simple returns, which means that there's additional time involved to make sure it's done right. Okay, we have some foreign asset disclosures. We don't want any surprises with foreign income and foreign assets, so we make sure that clients disclose all that good stuff. And all of these matters result in a 9-page agreement, which has done wonders for us because when there are misunderstandings, we point to the engagement letter, which people should read. So that kicks off the tax preparation process. All right, right here in the email. Once they sign the engagement letter, the next thing is we ask that they upload their documents through ShareFile. Now, we have the link over here, and essentially it's a secure document repository where clients can upload their documents. And here, we even have a list of documents that we need them to upload. Okay, forms W-2, 1099, K-1, 1098, brokerage statements, closing statements, and so forth. We did this for the convenience of our clients so that they knew exactly what info we needed. What feedback did we hear about this? Well, the client said, well, I don't know what to send you. And I said, well, it's in the email that we sent out. And client said, oh, it was too long. I didn't read it. So when we send out emails that aren't long enough, then clients complain that they didn't get the information. When we include the information, we get the feedback that there was too much in the email. I didn't read any of it. So help me out, guys. How do we find the happy medium here? I have yet to find out, but we're going to keep experimenting. So now clients are asked to upload their documents. And then once everything's said and done, we ask that they fill out the tax questionnaire, which looks like this. Let me get this pulled up for you guys. And the one prehistoric part of our tax practice when we first started was that the tax questionnaire was this crusty PDF document that people had to print out. You heard that right. Fill it out by hand. Ew. And scan it back to us. I mean, it was absolutely ridiculous. And as soon as I opened Efros Financial, I said to myself, you know what? This is not going to work. So we need a fancy tax questionnaire so that our clients had an easier way of providing us the information. So I put together this form here, all right, which lives on our website, and it allows our clients to give us all the information that we need. Look at this. So it's a nice form with all these different questions. Those of you tax professionals who used to handle the LaCert tax questionnaire, some of this might look familiar to you. But if clients want direct deposit, they can click over here and they get new fields. This is a beautiful thing. By the way, this is based on Cognito Forms. That's the service that provides this form here. And if they answer yes to payments, they have additional fields. And this took forever to put together, but we put it in place so that our clients can easily and effectively give us the information that we want. Where were the issues then? Well, if we go back to the email, we see that this step number 2 is upload your tax documents. And the idea was to make step number 3 the last stage, in that once they fill out the questionnaire, we knew that we could get started with the returns because they would have uploaded all their tax documents already. Well, what do you think happened? In reality, what ended up happening was that clients would fill out the tax questionnaire first, okay? And then they would start uploading documents. So a few documents came in here, a few documents came in there, a few documents came in here, and a few documents came in there. The problem was that we didn't know when to start the return for a particular client. Some documents would arrive in April, some in May, some in June, some in July, and we would have to open up every return and look at what they gave us, what they didn't give us. And then if it wasn't enough, we go on to the next one. But if it was enough, we would start that return. So you see how that can quickly become inefficient because we're opening up every client's tax file to determine if they gave us enough or if there was more coming. We were never sure. So this year, the way we're going to alleviate that, hopefully, is we're going to make very clear in multiple places that the tax questionnaire is the last step that has to happen during the tax prep process. And it will only happen after all the tax documents have been uploaded. So there's going to be pop-ups, there are going to be disclosures, big boxes with yellow highlighted text saying, don't fill out the tax questionnaire until all the documents are in. And the idea is as soon as we get the questionnaire, we hit the ground running. Instead of waiting for some documents to trickle in here and there and never knowing when to begin the actual tax prep process. So that is certainly going to be an adjustment that we make moving forward. And then finally, for new clients, there's an upfront deposit. And guys, if you're in a service business and you're not taking upfront deposits from clients, you're doing yourself a tremendous disservice because there are higher chances of misunderstandings with first-time clients than with the repeat clients that know your system, that know your business, that know how you operate, and they know what to expect. So by setting the expectation that there is a upfront deposit, you make sure that they buy in to the process and they have some skin in the game. Because what we've noticed is that in the tax business, some clients will shop around for accountants in that they will go to 4 different accountants, start the tax prep process with each one, and see which one results in the lowest tax liability. And with that accounting firm, they'll move forward and have them file their returns. Meanwhile, the other three that did the work, that went through the process, that filed their return potentially more correctly than the firm that they're going with, because their tax liability may actually be higher than they would like, they're going to go with the firm with the least tax liability and pay them. So you did all that work for nothing. Just like people doctor shop for pills, people will doctor shop for tax efficiency, all right? Whether or not it's correct is a separate story, but we've seen that happen as well. That's why new clients have to pay an upfront deposit. Sometimes it's 100%, sometimes it's 50%, but certainly you want to get something upfront. So that is the process that we had in place for 2021. Basically, clients sign the engagement letter, they upload their tax documents to ShareFile, they complete the tax questionnaire after all was said and done, which was the idea. Didn't turn out that way in practice. And then they pay the upfront deposit if they are new clients. So moving forward, we're going to make some adjustments based on what we experienced this last tax season, which we outlined here. First of all, improving the process. Setting the tax questionnaire as a starting point for income tax preparation to be submitted after all tax documents are submitted. That makes sense, right? It's a closure point that bookmarks the process and says, hey, tax guy, start working on this. Instead of waiting around for the tax document trickle to stop, and at that point, maybe we're good to go. So alleviate the ambiguity there and know exactly when the gun goes off so we could start running. The other aspect is that will allow us to provide quotes for accounting and bookkeeping services up front. And I don't know if there's another more neglected expense that goes into owning a business than the accounting and bookkeeping. So many of our startup business owners especially rely on good old Excel. And let me tell you, Excel is where the demons live. Quite simply, businesses that track their income and expenses in Excel, in most cases, have trouble putting together a clean income statement to use for tax prep, much less a balance sheet. A balance sheet is usually out of the question when they're using Excel. I'm just being candid with you guys. The income statement is a possibility, but it usually requires a good amount of cleanup because looking at Excel, you don't know what comprises that number that you're looking at. There might be one number there. It might be the sum of 18 different numbers. It might be a crazy formula in there. Nobody knows until you go and dig through it. That's why the financials that we accept from clients have to come from a double entry system of accounting, usually QuickBooks. All right, because there it's much harder to hide amounts or to do some crazy calculation because it's debits and credits, double entry, right? That's a change we're going to make. So as soon as the tax questionnaire comes in, meaning all of the documents are uploaded, we look through it and we say, oh, you need accounting bookkeeping services. Here's a quote up front. That can happen way back in February or way back in March, as opposed to in August, where we finally have a moment to take a look through the return and we see that, oh my goodness, there's a full year of accounting and bookkeeping that needs to be cleaned up before we even get to tax prep. The way we did it this year was we basically said, you know, we are going to get the accounting bookkeeping done as much as possible without billing additional amounts for it because we didn't have time to communicate to the clients that there's that additional fee involved. Well, moving forward, we're going to address that up front and say, here's the quote for accounting and bookkeeping before we even touch the tax returns. Take it or leave it. But this is a necessary step before we touch the returns because you're signing those returns under penalty of perjury. And if you have weak accounting, all of that is going to go on the return, which might be difficult to defend later on. And out of 100 Excel files that we receive, I would say 98 of them need some cleanup at least. So the idea is we provide quotes for that up front to avoid any ambiguity on that front and also to avoid doing free accounting bookkeeping work because unless you start billing for this stuff every year, you're going to get incomplete Excel documents with all the demons living in it behind those formulas. All right. So that is one step that we're going to take. Then, once that tax questionnaire is in, that also allows us to identify what's missing. So we can request those additional documents earlier in the year, giving clients more time to get it to us so we can get the returns filed and out the door, hopefully by the middle of the year if they're on extension, preferably before the April deadline. All right, but that questionnaire signal is going to be huge in terms of making sure we can get it done. And again, guys, as you're watching, feel free to smash that like button, subscribe to the channel if this is providing value for you, and drop some comments down below. I'd love answering your questions, and we'll address any comments as they come in. All right, next, screening potential clients. This is a big one. And the process for screening clients when you're a small fry just starting out and when you become more established will typically change because you'll better understand what clients you can knock it out of the park for versus what clients not the best fit for what you do. Way back when I began, I would take on basically anybody. Put a dumpster fire in front of me, I'll figure out how to put it out and get it on the right track. But over time, as you become more specialized and as your skills improve, you can be more selective in terms of the clients that you take on. And you don't have to take on every client that comes through the door. That's another lesson that you learn. And once you're fairly established and you've got some work under your belt, you can make that decision a lot better to avoid situations where you discover halfway through that it's not a fit. So extremely messy clients, clients that have a bad attitude, clients that have been negligent with their taxes for multiple years, whereas when you're starting out, you're going to be tempted to take on that client. But once you get some years under your belt, you might be tempted to say, hey, it's not a great fit. We need at least QuickBooks financial statements, at least a balance sheet and income statement. And that's going to allow you to maximize the revenue that you make per hour that you spend working. Simple as that. And that's a luxury that you get once you become more established. When you're first starting out, it's difficult to be selective with the clients you take on. But as you get more work, as you hone your skill set, you're that much more capable of making sure that you take on only the best clients that fit your business model, which creates a better situation for everybody involved. All right. Next, setting expectations. When we went through the engagement letter, we saw clearly it states in there that any return is subject to extension. Even though we stated that explicitly, we still had clients that were blown away by the prospect that their returns might not get done by April 15th. So we're going to be more clear and explicit in the fact that extensions are part of the tax filing process. And once clients get to that tax questionnaire that we pointed out, they're going to receive a big notice saying, hey, by the way, your tax returns might get extended. That's a possibility. So if you want to move forward, we have to be open to that. Okay? We want to file all the returns on time, but realistically, there's just not enough time to do that by the April 15th deadline. All right. In terms of optimizing the process, now once we actually start doing the returns, there's some room for improvement there because I'm a perfectionist, right? So sometimes in interviews, they ask you what your biggest weakness. You say, oh, I'm a perfectionist. Well, in this case, perfection can be the enemy of progress. What do I mean by that? What I mean is when we completed a tax return, it was subject to multiple layers of review, meaning the inputs were checked. They were checked again. Then the final return was checked. Every calculation was checked. Even if it was 2 plus 2, we double checked to make sure that that equaled 4, that the software didn't screw up. And that's way overboard. Way more than needs to be done. It took about 3 times or 4 times the time necessary to review a return just because I'm the guiltiest one here, was looking for perfection as opposed to good enough. There's a big difference there, all right? And that whole thing of, oh, well, I'm a perfectionist, so I need everything to be absolutely perfect, that can work against you. especially when you have your own business, because there's no boss telling you when enough's enough. So there's really not much stopping you from getting a little obsessive about some things, okay? Guilty as charged. But I'm working on it. I'm in a 12-step program. I'm on step 1/2 at this point. So I'll need a few more meetings and then we'll be all set. But if you have a business, it's crucial for you to make these sorts of assessments, because who else is going to do it for you? Simple as that, right? So these are the ideas that I had to make the tax filing process smoother moving forward, and wanted to share that with you guys just to show you what it can look like if you're looking to optimize your own situation. All right, and with that, drop some comments, questions down below if you guys have them, and we're going to shift gears and go on to some good old-fashioned Reddit tax questions. All right. Now, we're going to start with a question from the tax subreddit, which goes as follows. And like I said, smash that like button, subscribe to the channel. Let me know you're out there, because I love you guys. All right. This question is from the tax subreddit and goes as follows. Help! Didn't claim depreciation. I have a client who didn't claim depreciation on several properties her husband owned and rented out for 30 years. Husband is now deceased. Last year, she sold the properties. What to do now? All right, so this sounds like a tax professional actually reaching out. And there are a few different issues at play here that we need to address to manage this situation. So firstly, a client who didn't claim depreciation on several properties, husband owned and rented for 30 years. So we're talking about depreciation, and quite frankly, I'm not sure that CPAs would have too much to do with their time if it wasn't for good old depreciation, because as wonderful as it can be from a tax perspective, it is so easy to get it wrong. And then it's very difficult to fix it. All right. So in this situation, there are a few issues. That's one of them. The next one is that the husband is now deceased. So that adds another monkey wrench to the tax situation, if you will. Makes it a little bit more complicated. So we have a few steps here that we need to work through. Next, these properties were sold last year. Okay, so after the husband passed away, number of implications here. And this provides a little bit of insight as to how things can get complicated on our side as the tax professionals, because this is not as straightforward as it may seem. A layperson looking at it might go straightforward, bam, boom. But here's what goes through my mind when I look at this. So firstly, a client didn't claim depreciation on several properties, owned and rented. All right, so we know that these weren't personal properties. These were indeed rental properties. So depreciation would be necessary for the building portion, not the land, the building. That's another issue that comes up, is that clients purchase a property for $1 million to start depreciating on the million, whereas they need to only depreciate the building portion. It might be 600 grand, 400 grand, what have you. I did a whole video on selling a rental property, and we go into how exactly to separate building and the land in terms of the acquisition cost. But let's say you didn't claim any depreciation. In that case, you typically need to deal with wonderful Form 3115. And 3115 is the form used to correct depreciation issues. And you might think that this is a straightforward document, no big deal. How complicated can it be? Well, let's take a look at it. All right, here it is. And notice that this is only page 1 of 8. All right, so you have this wonderful goodness. You've got this beauty right here. Page 3 is amazing. All right, just take this in. All right, this is the form that the IRS requires to fix depreciation issues. It keeps going and it keeps going. So 8 beautiful pages, but that's not where it ends, because Form 3115 also requires a multitude of statements and schedules to be included to explain your change in accounting method. That's what it's referred to basically when you use the wrong depreciation method for 2 or more tax years. You're essentially locked in, and instead of filing amended returns, you have to deal with this beast of a form. And clients get all bent out of shape as to why it's so expensive to deal with this. Well, I'll show you. I found an example of how to fill out Form 3115 online. Now, I'm not saying that this is particularly correct, and I'm not providing this as a template for you, because if you're a layperson trying to file 3115, I strongly advise against it, because you're very likely to get it wrong. I'm just laying it out there. Go to a tax professional, all right? So don't look at this as a template on how to file the form. I'm just showing you an example of what it can entail. So to fill out 3115, and we're doing this to correct depreciation that was done wrong in prior tax years. So there's really 2 ways that you could screw up depreciation. All right, so let's just illustrate them. Now, well, 2 basic ways you could screw up depreciation. Now, let's say you took a bunch of depreciation deductions, right? So you have a depreciation deduction here and here and here, and these are different tax years, right? So year 1 and then year 2. Okay, and so on and so forth. Let's see if we can extrapolate this here. All right, all the way to year 10. Okay, so this is the line. You took depreciation deductions, and then in year 11, you decided, oh boy, we're going to fix all of this. So in that year, essentially what happens is that you end up taking all of the deducted depreciation in prior years that you shouldn't have deducted as income. All right, so essentially you're asking for forgiveness, you're repenting, and you're saying, okay, all of these sins that I committed in the past, we're going to fix it this year. And in some cases, you take it all in 1 year in terms of additional income, or you may need to spread it out over 4 tax years, okay? So that's more advanced than we're going to get into now, but it gives you the ability to say, hey, IRS, instead of amending 10 years of tax returns where I took too much depreciation, I just want to take it all in year 11 as income. Again, might have to take it over 4 years, but the idea is that you're getting it all fixed in 1 year instead of having to go back and amend 10 years worth of tax returns. All right, so let's look at a different example where, let's say you didn't take depreciation, right? So in that case, that might look like this. So there was no depreciation taken, but you could have taken. There was allowable depreciation, right? So you maybe could have taken this much in the first 10 years. And in year 11, you say, hey, IRS, I didn't take the depreciation. Can I please have it now? And in that case, that's where you can get the depreciation that you missed in prior years. So this was allowable. You didn't take it. All right. And then in year 11, you get a big adjustment, meaning your income goes down because you had all these deductions that you didn't take. Now you're taking all the deductions in year 11. So it can be a huge tax benefit in that tax year because you're getting all those deductions. Now, assuming you can deduct them, that's a different situation. But that adjustment in that 11th year is known as a 481A adjustment. Okay. So when you deducted depreciation in prior years where you shouldn't have, or too much depreciation, then you get income in year 11. That's known as a positive 481A adjustment, right? Which means you're going to pay more taxes. Now here, where you should have taken depreciation, but you didn't, you had all these deductions available, but you didn't take them, you can take all of that in year 11, essentially, and that's a negative 481A adjustment. So in those cases, you typically would expect an increased refund or to lower your tax liability. So clients like negative 481A adjustments. They don't like positive 481A adjustments because that means more taxes in that year. Now, going back to the 3115, first of all, you'll see these change codes need to be worked out. All right. And just to show you here that on page 3, or this is page 4, you'll see section 481A adjustment, which is exactly what we just discussed. So enter the section 481A adjustment, indicate whether the adjustment is an increase, positive 481A adjustment, or a decrease, negative 481A adjustment in income. And that's where you put it. Now, Notice you have to attach a summary of the computation and an explanation of the methodology used to determine the adjustment. So look at this now. Now you can't just say, hey, that's the number. No. Look at all this explanation that you have to include. Let me get myself out of here for a second. And you could see that when you were in school and they said, show your work, this is an example of showing your work from a tax perspective, all right? So you have to identify what DCN number is applicable. It could be 7, could be 107, it could be about 150 different ones that can apply. Now you have to describe the method of accounting that's changing and the present method, the proposed method. I mean, you could see how this gets crazy very quickly, right? Then a description of the trade or business. Look at this. Statement of facts supporting the classification. This is an essay that you have to write. This is not a template, people. As tax pros, this is what we have to go through to fix depreciation in many cases, all right? This is Form 3115, real deal. Then there are all sorts of revenue procedures that we have to refer to, all right? You want to show the calculations, the methodology. They're very curious about how you came up with these numbers, especially if it results in a negative 481A adjustment, which means that it's beneficial for the taxpayer in that year where these adjustments are being made. Now, there's a description of the property, all of this different stuff, and clients say, why is it so expensive for 3115? This is why. All right, you have to specify the present method, proposed method, the class life, all this stuff, and it's still not over. You still have all of these different amounts and explanations that you have to include with 3115. On top of that, you have to answer all these wonderful questions, like, for example, are there any tax returns under examination? Or do you have depreciation under certain code sections and so forth? I believe that occurs later in the form, but you get the idea. It's very involved, all right? On top of that, you have to understand that if you have a positive 481A adjustment, you have to take it over 4 years typically, all right? Especially if it's over $50,000. That's why they have a de minimis election over here. This is why I say if you have depreciation issues, don't try to fix it yourself because it requires a tax professional in many cases. Now, if it's less than 2 tax returns that you use the incorrect method, you may be able to file an amended return and avoid 3115 altogether. But in many cases, this is what you do to correct issues. Now, let's go back to our question. This person didn't claim depreciation on several properties that were rented. So we now know that the solution in these cases is that you file Form 3115 because it's more than 2 tax years that this was done incorrectly. So many cases, you have to file that form. Now, the husband is now deceased. That brings in another income tax implication, which is the step up in basis. So depending on whether these properties were separate property, meaning at the state level, they're considered to have been applicable to only one spouse and not the other, that can determine whether there's a full step up in basis or a half step up in basis. Let me provide a little color on that. Let's say that this is all community property. It's a community property state. And when the husband passed away, there was a full step up in basis. The properties were all worth $10 million. Now, in that case, the prior depreciation issues really aren't applicable in this limited sense because the fair market value at the date of death is essentially going to be the new basis, right? You still have to allocate between building and land, but it sets the bar to where it erases all of those prior depreciation issues essentially if there's a full step up. Now, there could be a half step up where essentially if it's worth $1 million, only half of the assets step up and not the other half. So you have to then still deal with this depreciation issue to calculate what the basis is of the share that doesn't step up. You see how involved this gets? That's what I really want to communicate. I'm not trying to do a master class on reconciling this. I just want to show you guys what goes into fixing these sorts of issues and figuring all this out. Now, if there is a full step up in basis, that makes it a little simpler in that once the properties are sold, you have that fair market value at date of death that you compare to the date of sale. If those occurred relatively close together from a time perspective, then there might be just losses, because if it's worth $1 million at date of death, sold $1 million 2 months later, you typically have the selling expenses that you can deduct as loss, and it turns into a long-term capital loss. Even if the person was only deceased for 2 months, it's still a long-term. Even if you sell the property the next day, long-term capital loss. Now, the depreciation in that case, I said it didn't apply to the step-up in basis aspect, but the question comes to mind. If this person passed away and they had a high tax year, can you then file 3115 for their final tax return to lower their tax liability that their estate would be responsible for? That's an idea. So if they, on their final tax return, had a tax liability of, let's say, $300,000, you may be able to take a 481A adjustment and get that income down lower and get a refund of some of the taxes. Now, the other question comes in as to if they didn't have a high tax year in the date of death, but they had a high tax year the year before that, is it possible to then do a 3115 adjustment in that year? And what effect would it have? All right. So a lot of different aspects can come into play here. So now we talked about fixing depreciation, Form 3115. We talked about the fact that there could be a partial or full step up in basis. That's a whole nother issue that we need to address. And you have the fact that the properties were sold and how to calculate the gain and loss on that. So full step up in basis makes the gain loss calculation a little bit more straightforward. But if it was a half step up, then you have to factor in the depreciation adjustment. Then you have to factor in what the gains and losses are. And that could be a lot more involved in and of itself. So in this case, hopefully this illustrates the extent to which the tax professional has to go to, first of all, assess how to approach this, because you have multiple moving pieces, and then how to reconcile it. And sometimes if you're filing this form, it just never ends. The 3115 just keeps on going and going, and you might spend hours on it and be only halfway done, because each one, as you can see, is customized, and you have to explain yourself to an extent that's unreal, essentially. It can really take up a whole bunch of time to fix what doesn't seem to be a huge thing, right? A lot of clients will say, just put the extra depreciation on the next return and that's all fine. No, it's not, because it can be disallowed if it's not done properly through the proper channels. All right. So we have a question from Maria here. Thank you guys for your questions. I appreciate you. I remember you, Maria. You were on the last stream as well. Thank you so much for coming back. I appreciate you. All right. Question is, on rental property, I'm confused on when it qualifies for qubit. Wonderful question. And it's actually funny, because prior to the Tax Cuts and Jobs Act that introduced the qubit or qualified business income deduction, which provided generally up to 20% of a deduction in certain cases of income. Prior to the Tax Cuts and Jobs Act, owners of real estate were saying, we're not a trader business. Are you kidding me? No, absolutely not. Not us. We're not a trader business. No, no, no. The reason they were saying that was that they didn't want to be subject to self-employment taxes, right? Because if you had a trader business, you'd be subject to self-employment taxes in many cases, and they didn't want that. So they said, no, 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 we're not a trader business. You're out of your mind to think that. How could you even consider that? Okay? Then the Tax Cuts and Jobs Act came along, and it basically stated that if you have trader business income, then you get this wonderful deduction. And what do you think the real estate people did? They said, of course we're a trader business. Are you out of your mind? How is this not a trader business? You got to be insane to think anything other than trader business when you look at real estate, right? Which led to a huge question for us tax people in terms of, is it a trader business or is it not? And to be honest with you, there's still some ambiguity in this respect, because the question is, whether one rental real estate property qualifies as a trade or business, or whether you need 5 of them, or whether you need 10 of them. Where's the line? And with the research that I've been able to do, and a lot of other tax professionals are in agreement on this, in that if you have one rental property, then just going from memory, unless it's having to do with the Second Circuit Court of Appeals, if you're out of the Second Circuit, one rental property, you're good in terms of the QBID, meaning you have a trade or business and you can take the QBI deduction based on the income from that rental. However, if you, again, going from memory, don't quote me on this, but if you're in the states that go by the Second Circuit, you may have a problem with claiming the QBID on one rental property, because the way the courts have worked out there is they've determined that one property would not constitute a trade or business. So you have to kind of weigh the tax laws and what the local courts have decided in many cases to figure out a tax treatment. But once you have more properties that you're dealing with, then it's easier to make the case that it's a trade or business. But the IRS says if you want to be treated as a trade or business, you better file 1099s. So if you have contractors that are doing work on that rental property, you want to make sure that you issue them a 1099, get the W-9 up front, because some of these people, they like to disappear whenever you talk taxes and try to get their information so you can file their 1099, because not everybody likes to report income, believe it or not. So in many cases, especially if you're in California, one rental property in general qualifies for QBID, but it gets much more complex than that. So I wouldn't generalize that too much, but you're not the only one confused on whether or not a rental property qualifies for QBID, because I can tell you that it's a pretty common question. All right. Well, with that, guys, thank you so much for taking part. I love it when you guys show up for our live streams. It's a beautiful thing. And I'm going to be getting some amazing guests that hopefully will show up. They will, to the next stream. Stick around for that. Thank you guys for your questions, for all of your comments. I love reading your comments. Like the video, subscribe to the channel, because there's going to be more amazing content to come. We always have fun together, guys. And with that, hopefully this was helpful. Thanks for watching.